Good morning, everybody. Hello and welcome to another edition of your Bitcoin economic calendar, the market moving news and analysis that you need to know for the week ahead in Bitcoin. Today is Monday, November the 16th, and we had Bitcoin's sixth consecutive week of gains over the weekend. There's a lot of talk about professional investors and institutions driving this rally. We're going to look at the data to try to spot some trends and implications. Additionally, we have some sector repositioning at play in the US equity markets, which we'll also be covering today. This and more in today's analysis. Starting as always with Bitcoin, we see that it closed its sixth consecutive week of gains this Sunday, reaching another high for 2020 at 15,966 for the week, up another 3.13%. Now, although we are nearing the highs of 2018, the feeling around the market and the community this time around is completely different. Recent events suggest that there is a great amount of interest around professional investors and institutions. Just this past Monday, we had Stanley Druckenmiller, another famous US billionaire hedge fund investor, went on CNBC to state that he holds Bitcoin and that he thinks it is attractive from a store of value perspective. We're going to be digging into the data to explore institutional versus retail activity in this Bitcoin rally and spot some trends and implications in today's market trends section. Moving on to the S&P 500, we see that it had a good week, up 2.16%, with the markets picking up last week after a lower than expected inflation reading out of the US on Thursday afternoon. As we had mentioned on the last BEC, we're starting to see some sector repositioning around the US equity markets following the election in the US. The price action this week in the NASDAQ and the Dow Jones gives us a picture-perfect opportunity to see this at play. Looking at the NASDAQ, we see that big tech is under pressure, which is predominantly a technology index, and it had a pretty rough week, down 5.54%. Now, this is consistent with what analysts had been predicting, as investors are concerned that the new Biden administration will be more prone to pursue antitrust probes against Google, Amazon, Facebook, and the like, which have all been market darlings and have led the market this far higher. Now, if we contrast this with the Dow Jones Industrial 30 Index, we see that the industrials are in favor. They had quite the opposite week last week, up 4.08%, and this reflects the belief that the new administration will be eager to support companies that create jobs for industrial America. This will likely favor this sector. Equally, industrial companies are looking to benefit from a weak dollar for their exports, which the Fed is aggressively pursuing to drive up domestic inflation. By making U.S. exports cheaper, conversely, they also make international imports more expensive, which creates inflationary pressures for the US market. We're going to dive into this next week because it is very important and it does have some implications for Bitcoin. Now, moving over to gold, we see that it had a bad week last week, down 3.19%, almost erasing all of the gains from the previous week. Now, although it seems like gold has been bouncing around quite a bit, it actually has remained flat essentially for the last 2 months. This is not surprising, as that is approximately the last time we had some debate around US stimulus. The price action here lets us contrast what a traditional inflation hedge asset behaves like in comparison to Bitcoin. And the contrasting price action between these two is a telling sign of the momentum that Bitcoin has in the market right now. Now moving over to the FTX DeFi index, we saw that it had a rockstar recovery week, up 9.11% on the back of momentum from DeFi blue chip tokens such as YFI, Aave, and Compound. With the rise in value in Bitcoin and Ethereum, the proxy of total value locked in these platforms rises, which creates upwards pressure on their token prices. There's a good chance that these tokens continue to rise in price if Bitcoin and Ethereum continue to sustain momentum upwards, although it is uncertain whether the price gains in these tokens can be sustained. Nevertheless, we will continue to track them as they are a good heuristic for euphoria in the markets, and it can tell us a few things about what may be ahead in the Bitcoin markets. So in today's market trends section, we were supposed to talk about the foreign exchange anchor for the US Fed. However, there's very important information that I think needs to be covered this week. So instead of doing that, we're going to move that to next week. And this week, we're going to talk about what is driving this Bitcoin rally and look at some data. Now, this rally feels different. There are no celebrity endorsements. There are no everyone's getting ridiculously rich on crypto and you're not mainstream media articles. and there are no Uber drivers offering unsolicited advice about the next Bitcoin. There's no altcoin euphoria either. The DeFi craze has all but dissipated, although it has been showing some signs of life as of last week. For context, last time Bitcoin was at 16,000, which was in December 2017, Ethereum was at around $700. It's currently around $440 at the time of this post. Litecoin back then was around $312. Currently, it's sitting at around $62 at the time of this post. These factors lead many to believe that the FOMO and the buying driving this Bitcoin rally is coming from somewhere else. Demand from institutions and professional investors. Now, in today's market trend sections, we're going to look at this data and see if it supports these claims. So let's look at some data. First up, we're going to look at Google search trends for Bitcoin. Google search terms currently show Bitcoin at a reading of around 15, which is nowhere near the levels reached leading up to December 2017. The first time Bitcoin reached 15 leading up to that rally was actually on June 1st, 2017, when Bitcoin was trading at around $2,300 and it had just been at $1,100 2 weeks prior. This suggests that the level of retail involvement at this time has been low in comparison to the previous rally. Second, let's take a look at mainstream media news coverage. Although we have seen a high number of mentions for Bitcoin in the broader business news channels like CNBC, Yahoo Finance, Cheddar, and Forbes, we have not yet seen the same level of coverage outside of the industry media or finance media. We've started to see endorsements for Bitcoin, but these are not coming from celebrities. Rather, they're coming from celebrity investors. People like Raoul Pal, Stan Druckenmiller, Michael Saylor, Paul Tudor Jones, and Jack Dorsey are the ones talking positively about Bitcoin this time around, but they're not covered by NBC, CNN, or Bravo. They're covered by specialty finance publications. It's a far cry from the Snoop Dogg's, Pitbulls, and Sylvester Stallone events that we had last rally. The broadest coverage to date has probably come from Financial Post, Wall Street Journals, or Forbes. This is another sign that market participants to date may not be your average retail investors, but more of a professional crowd. Now, this is some fascinating data. Let's look at the volumes in regulated futures markets versus volumes in futures markets in general to see if we can spot some trends. So, traded volumes for Bitcoin futures, including regulated and unregulated platforms, has increased from $2.7 billion in November of 2019 to about $6.1 billion in November of 2020. This is an aggregate increase of 117%. Now, zooming in, we see that volumes in regulated Bitcoin futures venues like the CME and Bakkt, the CME is the one you have on your screen right now, for the same time period have exploded in comparison. CME futures have grown from $129 million in November 2019 to a current open interest of $938 million. That's a 627% increase. Bakkt has also seen an increase from $1.1 million in November 2019 to $20 million now. While small in absolute terms, that's a 1,718% annual increase. This tells us that, relatively speaking, institutional activity has been growing faster than retail activity. Now, for our next data point, we're going to look at price action during traditional financial market hours. Some market participants, as you can see here, this tweet from CMS Holdings, have highlighted that positive price momentum for crypto markets seem to be linked to the operating hours of traditional financial markets. While these are anecdotal comments, we've also reviewed price action during North American market opening hours and have noticed that there has been a positive momentum during 2 out of the 3 last opening weeks, as per the charts included in the blog. Positive price action during traditional financial market hours can be an indication that there is buying demand coming from these traditional finance market participants. Now, what can we conclude from this data? The data suggests that there is substantial increased demand from regulated venues and little to no signs of retail FOMO yet. What are the potential implications of this? There are several. An important one being that professional investors suffer from groupthink just as much as retail investors. There is a possibility that Bitcoin continues to gain on the narrative of inflation hedging, and professional investors also see a lot of potential of Bitcoin's grabbing store of value market share from gold, especially amongst the millennial demographic. For context, gold is a market that is approximately 18 times larger than Bitcoin, and all of this could be setting the foundations for a very strong and prolonged rally. Now, moving over to a Bitcoin mining difficulty commentary, we are due for a difficulty adjustment today, and hash rate has actually bounced back quite strongly. Last week, we were looking at a potential downwards adjustment of negative 13%, and as of now, we're looking at an upwards adjustment of around 2.3% to 17.18 terahashes. Transactions in the mempool have been absorbed quite well, and the transaction processing times for Bitcoin should be back to normal. Lastly, that is a pretty healthy bounce, so it shows some resilience on the side of miners, and that bodes well for Bitcoin. So as always, we leave you with what's ahead for the week. Now, although the Fed came out with a really strong statement 2 weeks ago, the soaring COVID cases worldwide could lead to renewed shutdown conversations. This could put pressure on equity markets, and with legal tensions still lingering around the U.S. administration, it is unlikely that we will see any real traction around U.S. stimulus until the Biden administration takes over on January 20th. For now, the markets will be on their own, which may lead to continued repositioning and some inflation hedging. Additionally, PayPal made Bitcoin available for purchase to its U.S. clients last Thursday, which should be a tailwind for Bitcoin going into the week. As always, we'll keep you posted with any relevant information throughout the week through our social media channels at Hodl with Ledin. And if you don't yet have a Ledin account, check out Ledin.io and learn how you can start saving and earning 11.7% on your USDC and 6.5% on your Bitcoin. Thank you, everybody. Have a great week. And if you like what you saw, subscribe and share. See you next one.